Good morning, everyone. My name is Rhenda Nugent, and I am the founder of Stop, Listen, and Learn, and my team of experts. And I would like to take the time to thank you personally for taking time out of your busy schedule to join Stop, Listen, and Learn on our journey to building generational wealth. This webinar is a 4-part series. So every Saturday for the next 3 months, January, February, and March, that's January the 9th, February the 13th, March the 13th, we will have a session that will deal with building generational wealth. Today's discussion is for information purposes only. No legal, tax, or financial advice given during this presentation should be interpreted as a guarantee for your personal situation. You should consult a personal or a legal, tax, or financial advisor for specific situations. So let me reiterate that again. No legal, tax, or financial advice given during this presentation should be interpreted as a guarantee for your personal situation. You should consult a legal, tax, or financial advisor for your specific situation. This is for information purposes only. But before we begin, let's go over some housekeeping rules. Please, let's mute your mic. That's the first thing. Place all questions in the chat box, and they will be answered at the end of the session. And the reason why we're doing this is because your question, may be answered through the session. But if not, we will stay late or after the session and answer any questions that come before. Be mindful of your background. Now, you all have heard about people on Zoom, and we've been getting treats on Zoom, and we don't want any treats today. That may be walking in the background of this Zoom session. So make sure you mute your mic, and if you want to keep yours blacked out so we won't see any treats, that's fine too. But let's talk about Stop and Listen, Learn mission. Our mission is to use our resources to inform, educate, and empower people. We have a team of experts in the area of women's health as it relates to mammography and breast cancer, real estate, taxes, estate planning, media production, therapy and counseling, financial advisory, and legal advice, and that's just to name a few. So I want you all to understand that we're going to talk about building generational wealth. And this is a process which uses principles and strategies to help people reach their goals. As it relates to manage your money, I know what y'all thinking, oh my God, I got to sit up here and talk about manage money. But we got to start with the basics. We got to start somewhere. And usually you start at the beginning. Let me reiterate, this is for information purposes only. So let's get started on your journey to building generational wealth by using these strategies and principles set forth in this session. Now, the key word is generational. This means you have to set the tone and develop a system for the next generation in order to be generational wealth. Okay, so I don't want anybody coming back. Now, some of y'all know me by Rhenda, some of y'all know me by Rennie, but I don't want you all to say, guess what? I attended this session with Rennie, and they was talking about generational wealth and building money, and I'm still broke. Well, broke is all relatives, because what may be broke to you may not be broke to somebody else. And we have to start somewhere. So we got to make some money-making moves, okay? Again, this is a 4-part series, so this is a process that we're going to go through, and we don't want everybody to be overwhelmed, and that's why we broke it up into 4 different series, okay? Now, let me give you a situation, because Michele Hallman is going to be your first speaker, who's going to give you information. She's going to talk about credit, she's going to talk about debt, and she's going to talk about cash management. Well, I'm going to give you an example of Miss Michele, because Michele is my tax attorney. And as you all know, I'm a businesswoman, I'm a real estate woman, and I am a mammographer. And so I got my hats in a whole lot of different things. And by having in so many different things, I move money around. And so sometimes when you do that, you get in trouble. So I had a good year. And that good year, we were flipping houses. And I knew I would have to pay, but I didn't think I had to pay that much. And so I went on and paid. I did my due diligence and I paid. And then a few months later, I get this nice little letter from the IRS saying that I owe them some more money. And I'm like, I just paid you out of the yin yang. And so I go back to my accountant and she was like this and that. And I'm like, she didn't want to deal with it. So I had a new accountant. He didn't want to deal with it. So I had to get somebody who can deal with both of them. And this chick came in with full force like a bull. Michele came in there. She went over everything and she got on both of them and told them what they did wrong as relate to my taxes. And she handled it. And by the time she finished and she dealt with the IRS owed me money. So, I was really happy about that. So Michele knows what she's doing, how to do it, and how to get it done. And the thing about it is she will fight for you. She will fight for you. She is the owner of Taxology, and she's a tax attorney, and she will start making moves. Michele, I'm going to turn this over to you.
Okay. Thank you, Rhenda, for that nice introduction. I almost forgot that I had to put up my dukes that time and knock the IRS out in your behalf, but we got the job done. And I'm happy to say that I've gone on and done the same thing for many other clients. I want to position this webinar and this particular presentation in the context of the next three, as you did. This one, as I have mentioned, is only going to cover credit, debt, and cash management. Now, some of these things I know, people already know, but it's worth reviewing. Throughout the course, by the time we get to the end of the presentation, I went back and I counted, I looked through the PowerPoint slides, and there are no less than 30 new strategies that you may not be aware of, or you may have heard or forgotten about, which if you implement them, will certainly increase your ability to have more money at the end of the month and at the end of the year. As a tax attorney, I'm particularly interested in having my clients in that situation because that means that they have more discretionary income, they can save, they can take vacations or buy something that they may need, perhaps an addition on the house or something like that. But more importantly, they can put money aside to create generational wealth because they have money left over. And in some instances, if they need to pay money to the IRS, it's not a stressful situation because they have managed their credit, they have managed their debt, and they've also managed their cash so they can make that payment with ease and not give a thought to it. Which which brings me to this quote, and money is just a tool. It'll take you wherever you wish, but it will not replace you as a driver. So you have to really be in control of what you're doing with your money and where it goes. And that has become even more important over the last 10 months while we're being faced with this unprecedented pandemic where over 255 million people are now just living paycheck to paycheck because of the devastation of COVID-19. Even before then, we had people, and most everyone, and this is an average, the American household has over $117,000 in debt. Now that is probably their vehicle, maybe they own some other things, but about 107, maybe student loans, that's also included in the number, $117,000 worth of debt. And in the district, Maryland and Virginia, the average amount of mortgage debt is $252,000. So just to give you a sort of perspective about where your peers might be, the average credit card debt is $15,000, $16,000. I personally think that number is a little low. It may be a little higher. Some people, are not carrying that much debt, but we're going to talk about if you are carrying that much credit card debt and you are just tired of it and you feel like you're never going to get from up under it. I'm going to talk to you a little bit later about some strategies where you can get from up under that debt in 12 months, if not less, if you're disciplined. Credit is something that I think when we all first start out and you can get your first credit card, we're all anxious to do that because we know that that's going to give us the ability to leverage our income and maybe purchase some things that we wouldn't be able to afford unless we did it on credit. One of the things, four of the things that I'm going to talk about and just give you an overview of are what's your credit score? What goes into that credit score? what is bad credit and what are the things that impact bad credit? How can you dispute that credit? And how do you build credit? What if you're just starting out? Maybe, unfortunately, you just went through a bankruptcy. How are you going to rebuild your credit? Or how do you ensure that you're able to, if you want to access credit, that you're being offered the kind of credit opportunities that allow you to buy the things you want and you can afford it? And then finally, I think I mentioned this, but how do you repair your credit? What are the steps that you can take to aggressively look at maybe derogatory items on your credit bureau and find out the mistakes, find the errors, and what do you do? How do you do that? And does that work? There are three different types of credit. There's revolving credit, which we commonly refer to as just credit card debt. And that could be, your Visa, MasterCard, any of the store credit cards that you have. And that's the most common credit card. Basically, you're required to just pay a minimum amount every single month. And then the remaining balance, if you don't pay off the whole thing, is rolled over to the next month. Then we have charge cards. Not really that prevalent anymore, but maybe 10, 15 years ago, the two most common were Diners Club and American Express, where you charge something and let's say your balance was $250, the bill would come and the expectation was that you would pay the whole bill at the end of the month. Those kind of charge cards are, you see a lot of Fortune 500 companies or Fortune 50 companies actually offering those to employees so that they can charge items, business related items, because those big corporations can of course get the bill at the end of the month and pay them off, and not worry about carrying a balance from month to month. And they're also good for individual consumers if you decide, I don't want that revolving credit, but I know I'm going to be able to pay it off in the next 3 weeks or whatever. Let me just put it on the charge card and then, I'll pay it off. Finally, the remaining type of credit is an installment loan, typically a car loan. Maybe you even get a personal loan. And these kinds of credit opportunities through an installment loan are what we're most familiar with because it's a set amount, say $15,000. You pay a set amount every single month, and it's for a fixed period of time. So you know that when you get to the end, that's it. You're done. You don't even have to worry about it. Where does all this information about what kinds of revolving credit or installment loans you have go to? It goes to, in America, it goes to the big three credit bureaus: Experian, Equifax, and TransUnion. They collect, and I put the dates that these companies were actually founded to let you know they've been around for a long time. They've been in this business. They've been collecting information about consumers since the 1800s. You can see Experian is the oldest, and it started, back in 1826, and it operates in 37 countries. So Americans aren't the only ones whose consumer habits, lending and credit habits are being collected. It's other countries as well. Equifax, also in the 1800s, and it began as a group of tailors in England, where they were collecting information about whether or not people who were buying clothes and getting tailored pants or suits would be able to pay. And then TransUnion is actually a conglomeration of smaller credit bureau reporting agencies. TransUnion is the umbrella, and it bought a lot of these smaller companies, and it's the company that it is today. We really started to see that in 1968. And it actually has probably a consumer profile on just about everybody. One of the things to know about the big three is where they get their information. And I'll go into more detail. You'd be surprised. Every credit card, every installment loan, car loan that you have, that, if you have a Ford truck or you have a Honda, the credit agency or whoever's holding your loan, they report that information to TransUnion, Experian, Equifax every single month, whether or not you paid on time or you did. But that information gets routinely reported. And that's part of what goes into your credit score and determines what is your FICO score. And your FICO score, as we know, it's a scale that's used to determine whether or not you are a good credit risk. And there's an algorithm, and I'll show you what goes into that algorithm, which determines what kind of score you get, whether you're a bad credit risk or an excellent credit risk. All three of these big three agencies, they use a different formula, but mostly they're looking at all the same things, and they give some things a little more weight than others. But basically, they are looking at whether or not you are a good credit risk. So in other words, if you decide to get the car loan, what's your chance of defaulting on that car loan? Or is that unlikely? If you have a credit score of, let's say, 720 to 850, it's very unlikely. And it predicts it predicts your future paying ability based on your past paying ability. So if you've had good credit in the past, and you've paid on time, it's likely that your score is going to continue to rise and go up. And if you go and seek new credit, they're going to say, oh, look, for the last 10 years or 5 years or 6 years, they have 7 or 8 accounts open, and each one of them has been paid on time. That's a good credit risk. We're more than happy to lend them money. So the FICO score is comprised of 3 categories, and they're weighted a little differently. It's number 1, the payment history. And I was just talking about that. How long have you had the account, and do you pay on time? Or are you 30 days late, 60 days late, 90, 120 days late? So if your payment history has continuously been pays on time, that counts for a whole lot, 35% of your FICO score. And then your credit utilization. This is kind of really important because I have had a number of clients who've had 5 or 6 cards with low balances, or maybe a couple with high balances. And they say, oh, I'm so glad that I finally paid off that credit card. And then they close the account. All right. And I'm like, why did you do that? That's just, you don't do that. The credit utilization means essentially, if I have 5 credit cards and each one of those credit cards gives me the ability to charge $1,000, that means I have $5,000 worth of, $1,000. That means I have $5,000 worth of credit available to me. All right. If I only use $100 of it, my credit utilization score is very low. And what that says to FICO, or what it says to FICO, to my FICO score, and to Experian, Equifax, and TransUnion is, even though Michele has the ability to borrow a lot of money, she's not interested in it. She's restrained in how much credit she's actually using. So that means my credit utilization score will be very low, and I'll get bonus points on my FICO score for that. If, however, I have those 5 credit cards with $1,000 on each of the cards, and I decide to close one, and then, for instance, I decide I'm going to charge $2,000 worth of, on across the cards, then I have 50% credit utilization. That's bad, because they say she's almost at the, she's halfway, she's halfway there to using up all of her credit that's available. And it just makes you look hungry, and it will make your FICO score drop. The credit age, how long has that account been open? And that goes back to the example that I referred to, when somebody opened an account back in 2000 or 1995, and they just said, I never used that account. I'm just going to close it. Don't close it. Why would you do that? You've had the account open for, over 10 years, over 15 years. It doesn't make sense. It shows your credit history and shows that you have had access to credit for over 15 years, and you paid on time. Creditors want to see that. So if you have a card that has been open for a long, long time, maybe you don't use it as much, don't close it because it goes to the credit age. And as you can see, that's 30% of your FICO score. The number of inquiries is extremely critical because when you go to apply for credit, that ends up being factored into your FICO score. So if you are doing, and I had a client who did this, she decided one weekend that she was going to go buy a vehicle, and she went to 4 different dealerships. Each one of those dealerships made a credit inquiry and dropped her score from high 700s down to low 600s. And she couldn't understand why that was. And I said, that's because you had all these credit inquiries. And when the FICO score, or when the FICO score was calculated, and when the credit bureau reporting agencies looked at it, they became alarmed. They said, "What, what's going on? Did you lose your job? What's going on that you are seeking out credit and you're having all these credit inquiries?" So that really impacted her, and she ended up getting a vehicle. But unfortunately, she wasn't able to get the favorable interest rates that she really should have been entitled to, because she had had those credit inquiries made on the account, and it dropped her score. And then finally, the different types of credit. What does that mean? Well, I just showed you that there's 3 different kinds of credit. So you can have charge cards, or you can have installment loans. And that impacts your FICO score because it shows how you're able to handle different kinds of credit. If you have an installment loan and and it's a 5-year installment loan or a 3-year installment loan, it shows that you are consistently able to make your monthly payment for the 36 months. And they like to see that. If you have credit card debt, that's another type of credit, and it shows that whether you add on to that credit card debt, you still consistently make your payments. And that's also something that they like to see. Now, what makes up a bad FICO score, and what are the things that impact that credit score? Making late payments, the obvious things, making late payments, maxing out your credit cards, which unfortunately impacts your credit utilization, applying for too many credit cards or too many loans, closing zero balance lines of credit. That's also problematic. Just leave it alone. Don't do anything. Refusing to use credit. Now, you may think that that's a way of resisting temptation, but it also doesn't give prospective lenders an opportunity to see whether or not you can handle credit. So not using credit and being a cash only individual is going to be problematic. And it's problematic when you're trying to buy big ticket items like a car, or you go to apply for a mortgage. That's always going to be a problem, because no one's going to lend you $300,000, even if you have a wonderful salary and on the face can afford to purchase the home and service a $300,000 mortgage. Very few banks are willing to take that risk because you don't have any history. You have income, but we don't know about how consistent you are and whether or not you're going to make that mortgage payment. So refusing to use credit at all is not, it's not the best strategy. Having a bankruptcy for obvious reasons, charge-offs. And essentially a charge-off is when you have not made a payment on a loan or a line of credit or a charge card for 6 months. The lender essentially says, we're never going to get this money. We've sent them to collection agencies, we're just not going to get it, and they charge it off. A charge off is fairly significant, and that's going to drop your credit score. Judgments. So if somebody sues you and you lose, and they get a money judgment against you, and this is very much in my sphere, tax liens. So you want, and the IRS is essentially, and I remind my clients of this all the time, the IRS is essentially just a big collection agency. All right. So they do all the things that you would expect the collection agency to do, except call you. They send you a lot of letters. And if you don't answer those letters, eventually they will file a tax lien. Most important thing, avoid all of this at all costs. You can, before you get into a problem with a tax lien or a charge off, try to make arrangements. Okay. And we'll talk a little bit about how that actually works. So, you want to know how these negative items impact your credit score? Here's how this is how it actually impacts it. So let's say you have a beautiful score, you're in the high 700s, or maybe you're even at 800. You make a late payment, and that can decrease your FICO score up to 110 points. Right? Maybe not, and it depends. Usually it may go down by 110 points if that payment is a large payment. Let's say the payment is $1,500 or $1,600 and you don't make that payment. It could drop your FICO score down by 110 points. If you do a debt settlement, so if you owe 2,500 and you go back to, let's say, Macy's or JCPenney's and you say, look, I can't pay the whole thing, and they decide, well, okay, we'll take pennies on the dollar, that will actually drop your credit score. And the reason why that happens is because it shows the creditors they didn't pay the full amount. So if I lend to them, there's a good chance that I'm only going to get pennies on the dollar. That's not a good perspective or a potential person that we want to lend to. So your FICO score reflects that. Foreclosure, you've lost your house, you haven't been able to make mortgage payments. That's problematic, up to 160 points. Bankruptcy, obviously, especially if it's a Chapter 7 where you wipe away all of your debt that you may have, installment loans or credit cards, or sometimes medical costs that have gone to collection agencies. A bankruptcy could drop you down 240 points. And then a collection, even if you subsequently take care of it, if your account ends up going to a collection agency, you could see your score drop by 110 points. And then that client that I talked to you about before, who went to multiple car dealers and had all those inquiries, she 15 points. Each time they pulled a credit, it was 15 points. Boom, boom, boom. In her case, I think she was looking at big vehicles like Teslas, and so it really dropped the score. It was problematic. And when we say hard inquiry, that means seeking new credit. A soft inquiry is when somebody who you already have a credit relationship with, let's say you already have a Macy's card or you have a car loan, periodically, and if you get your credit bureau report, you'll see that those people that you owe money to will take a peek at your credit bureau just to see if you're doing anything else. They know that you owe them money and they want to see who else you're trying to get money from, or if you haven't made payments, or how has your credit score changed since they lent you the money. Essentially, they're trying to mitigate the risk of you not paying what you owe them. So that's the difference between a soft credit inquiry, which has no impact, and when you look at your credit bureau report, that's actually a soft inquiry. So it's as if there was no inquiry at all. A hard inquiry is when you actually are seeking new credit. And then, of course, delinquent payment, you know what that is. Now, these stay on your report for a number of years, and they drag your score down. So the hard report stays on for 2 years, delinquent payments 7 years, defaulted account 7 years, foreclosure 7, and then in bankruptcy 7 to 10 years. Typically, it's 10 years. And so all of that information is available for you to review, and for also prospective lenders to see what has happened with you for the last 7 years. Now, Rhenda, I know that you, as a real estate professional, have seen this time and time again, and know that when people go to apply for mortgages, depending on what their credit is, they can end up paying more than they need to because they don't get the interest rate that they need or they would like. So a typical example is when you have exceptional credit, somewhere between the 720 and 850, you may get a mortgage interest rate of 3.9% on a $250,000 loan. Your monthly payment is only about $1,100, a little over. And by the time you finish paying that mortgage, you haven't paid any extra. But let's say you get that same mortgage at 5%, your monthly payment is going to be higher. And at the end of that 30-year period, because you don't have good credit, you will have paid $58,000 more than the person who had exceptional credit. If you have bad credit, and unfortunately you have to get a mortgage at 6.3%, yikes, your payment is going to be 200, it's actually going to be 400, almost $400 more than the person with the exceptional credit. And then at the end of that 30 years, you will have had to pay $132,000 extra dollars to carry that same $250,000 mortgage. That's just mind-boggling, because you could do something else with that $132,000, and you could have actually bought another house, or certainly 2 cars, if not more than that. So having good credit benefits you in the long run because you have access to more money. You don't have to spend more than necessary, and it frees up cash for you to do other things. So for people who are seeking to build their credit, you should do these 5 things, and this will help you out. Check your report for errors. Every single year, every consumer has the ability to get a free credit report and check what's actually on the credit bureau. And you should do that. As part of this presentation, I went back and I looked at what was on my credit bureau, and my address was incorrect. So I went in and I disputed that and made sure they made the change. I love my neighbors, but I don't necessarily want any mail going to them because the credit bureaus have the wrong information. I want them to be sure that, especially the good information, is attributed to me. Like I mentioned, I've disputed the error in the report, so you're able to do that. And all of this stuff can be done online. 10 years ago, you'd have to formally write a letter and put it in the mail. Now you can dispute this right online. It'll take you less than 2-3 minutes to review and to dispute if you see some information that's incorrect. Take a look at all the, and then also you should also pay any late or past due accounts. I know sometimes, the reason why they're late or past due is problematic. If you had the money, you would pay it. But you should keep in mind, and particularly now because of the pandemic, many credit card companies are aware that Americans are struggling to pay their debt. And so you can actually talk to them. So if your minimum payment is $75, there's a possibility that you may say, look, I want to make sure that I'm making a payment. I don't want to miss a payment, but I can't do $75. What is the lowest amount that you will be able to take so I can continue to pay on a monthly basis and pay consistently? Most of the credit card companies would rather receive some money rather than no money, and they will work with you to try to drop that amount that you're paying on a monthly basis down to something that's affordable. Okay, so if you find yourself in a situation where you're looking at a late, you may have to do a late payment, or the account may be 30 days past due, call and negotiate with that company and see if you can, I'm making a payment, I'm doing it within the time frame that you're asking for, it just isn't the amount you're looking for. Get them to sign off on that. So it does look like you are responsible and you are consistently making that payment. And then, of course, pay off those high interest credit cards. But the most important thing is to be consistent. Now, Rhenda, I was talking about the benefits, and because you do real estate, what have you seen in terms of the impact of these FICO scores on people's ability to get mortgages?
We all know that your credit scores can affect your mortgage rate, but your credit can also affect how much you have to put down. So, and that will determine how much PMI. property mortgage insurance or private mortgage insurance that you will have to pay. So it's not impossible to get a home with damaged credit. It just may be more expensive.
Now, how do you repair credit? Now, this is, these are one of the things that you have to do. If you are committed to repairing your credit, there are things that you can do, and you just have to be proactive in verifying the misinformation and sort of pushing back on it. So as I mentioned, you get a free credit bureau report every single year. And you just got to check for those reports. And if you decide to dispute some information that's on your credit bureau that you think is incorrect, the credit bureau agency has 30 days to investigate it, go back to the creditor and verify that that information is correct. All right. So I have seen situations where people have very similar names. And as a matter of fact, that has happened to me. There's a young lady who I know of who has my name, who actually lives in Alabama. And she's not as responsible as I am. And our credit information was being conflated. I checked my credit bureau report to ensure, and I continually do that, to ensure that things that should be reported to her go there and that our information is not being conflated. She's irresponsible. I am not. And I don't want to have to pay by having a bad FICO score or having a score dragged down because she's irresponsible. So I dispute those errors that I do see. You can repair your credit by paying late or past due accounts. It always makes sense to pay off that credit. As I mentioned, even if you go into collections, okay, you can't just ignore it. You got to pay it off. And if you have a problem paying it off, then negotiate with the collections agency and say, I can pay a portion. Okay. But and the way it will show up on your credit bureau is that you've actually paid it off. It went to collections. You already take the bad hit, but you paid off, and it'll show that it was, paid off, not as originally billed, but that you were you didn't ignore this, that you actually tried to do something. Pay off your high interest credit cards. If you have 4 or 5 credit cards, if you look at them, there's probably one that you don't use because you know that credit card is 25% or higher. You're carrying money or paying for carrying credit and it's 25%. Leave it alone. Pay that credit card off and leave it alone. And you can also repair your credit by opening a new credit card. Do that judiciously. Don't willy-nilly just open new credit cards, but it may make sense for you to open a new credit card and of course pay your balances on time. Each one of these steps has a positive impact on your FICO score and will bring it up. Okay, it will take time. These are not, any one of these are not strategies that if you implement, you're gonna see instantaneous results. But if you consistently are taking care of it and addressing, late and past due accounts or increasing your credit limits where it makes sense, you will see your FICO score rise. And that makes sense because we know that the higher your FICO score is, if you're 720 or even in the high 600s, you're going to be offered better rates. And over the life of your loan or car loan, for instance, or a mortgage, you're going to end up paying a lot less money. So what do you really need to know? And I think I mentioned this, where the credit bureaus get their information. Most every credit card company, certainly all of the card lenders, always report the information to TransUnion, Equifax, and Experian. They do. They tell them everything. They tell them whether you paid on time. So so that credit reporting information goes like clockwork every single month. If you look at Experian and you look at Equifax and you notice that the score is a little different, here's one of the reasons why. For example, initially TransUnion was very prevalent on the West Coast. All right, so there were some businesses that that were on the East Coast that didn't report transactions to TransUnion. So your score with TransUnion might be lower. And so you'll see a differential between the two, between Equifax and TransUnion. For the most part, if you see a difference in your FICO score between the three, it's not going to be by that many points. If you see a difference of more than 50 points, then you need to look at the credit bureau that's reporting the lower score and check to see if maybe they have some misinformation, which is likely. And that's why you should check all of your reports, because the numbers are not likely to be the same across all of them. There may be a big discrepancy, and that's going to be problematic for you, because you don't know if you try to get a new car or you're trying to buy a house and you have a mortgage payment, you don't know, you know, whether or not the mortgagor is going to pick Experian or TransUnion. That 50 points could be the difference between you getting a very attractive mortgage rate and maybe a mortgage rate that's a little bit higher. But we saw from the previous example that when you're talking about hundreds of thousands of dollars over the life of the loan, that could end up being a car that you will never, ever get to drive. So this is why you should go in and check your credit report on an annual basis. I usually advise my clients to do it at this time of the year. Maybe they have a little downtime. It's not going to take you that long, but as a financial tune-up and as you get ready and you're preparing yourself for the oncoming year, take a look at it so you know what's going on, and you're not caught by surprise. Debt management goes hand in hand. Try to minimize your exposure. If you do find yourself in a situation where the debt is chasing you, there are some options that are available to you. You can do a debt consolidation. So what that means is, when I was in banking, we used to refer to it as taking your whole bunch of little annoyances and turning it into one great big headache. So essentially what it is if you're lucky, you try to get a personal loan for the outstanding amount that you owe on, for instance, all of your credit cards. And then as soon as you get that personal loan, you write a check to each one of those credit card companies and you pay it off. Now, instead of having 5, 6, 7 credit card payments and you feel like you don't know where to send the next check, you just have one great big payment to make every single month. Is easier to manage. And I have, that used to be a practice that was really quite prevalent, because some people are just like, I can't manage all of this. It's just a little bit too much. And then debt settlement. There are a lot of companies that do debt settlement. You have to be careful, because even though it seems like a way out of debt, those debt settlement companies often will charge you a fee to negotiate with your creditors. And what they're trying to do is they're trying to settle with your creditors for less than you actually owe them. So essentially pennies on the dollar kind of thing. But the tax consequence of that is, and I'll give you an example. Let's say I owe $5,000. I go to a debt settlement company. They subsequently negotiate with the creditor, and now I can pay $3,500. The company that I originally owed the $5,000 for will now send me a tax document for that $1,500 that I did not pay them. And the way it gets treated on your taxes is as if it is income. So now I'm no longer responsible for that, for the $1,500, but it shows up like I got a gift of $1,500, or somebody paid me $1,500. So it could have tax consequences. And then the other thing is, it shows up on your credit bureau as a settlement, and that you did not pay as owed. So, I owe the $5,000, but I didn't pay it. I might have paid on time while I had it, but I didn't pay the full $5,000. And other prospective lenders will see that and they'll say, why would I lend Michele money when I know I'm never going to get it all back? I'm only going to get pennies on the dollar. I won't lend to her. I'll find somebody else who will pay me back the money they owe me plus the interest. I'm not going to lend to her because that money's not going to go anywhere. I'm never going to get it all back. When you get serious about paying off your debt, now these are strategies that you can use. And I personally have seen at least 10 or 15 people employ the following strategies that I'm going to outline for you. And they just made a commitment and just decided that they didn't want to be in debt anymore. And it worked out for them. So the strategy is basically debt. It's called the debt snowball method. And all that means is, that your debt can snowball, but you can also snowball your payment strategy. Basically, you're accelerating the payments on debt. Which debt should you take a look at? Okay, so here's different strategy. You can pay off the lowest balance first, or you can do the highest interest rate first, or you can just say, I don't care, I'm just going to pay, I'm just going to pick one. And I consider that the no snowball. You can do debt snowflaking, which is you pick a credit card and you just say, all right, the minimum payment they're asking for is $75. I'm going to give them $150. You don't do that consistently month after month, but like a snowflake, you just drift down and you pick an account, and you pay it off that way. These are all debt acceleration strategies. It's just deciding how you want to accelerate that debt and which credit card or loan you want to apply that extra money to. There's also the stair stepper strategy, which I kind of like, which is when you have multiple, let's say, credit cards and the balances are like, say, between 1,500 and 3,000. And maybe you have some credit cards or some loans that are higher. You say, look, I'm going to use this stair stepper strategy. I'm going to take all of the credit cards that are 1,500 to 3,500, and I'm going to put as much money towards paying those off as I possibly can, because I don't want to keep those kind of credit balances. It's annoying. And then once that's done, I will go to the higher balance credit cards or loans and get rid of those. And it's really a combination of the debt avalanche and the debt snowball. Doesn't matter, as long as you're paying it off, it all benefits you in the end. And you get to pick and choose what you want to do. And then, of course, no specified order. And then you just decide, maybe the customer service at JCPenney's or Sears is just crappy. You're tired of dealing with them. That you create your own order. So that's the consumer defined order. I like using this particular spreadsheet, which is called a debt reduction calculator. And I'll share with you the website. And what you do is you enter the creditor information. If you can see the slide, you enter the creditor information. It's credit card one, auto loan, student loan, the amount, the balance that you owe. This is probably one of the most important columns. What is the percentage rate? How much are they charging you in terms of interest? You got to put that in there. And then what is your minimum monthly payment? Then if you see the strategy further down, you'll see if you decide I want to do the avalanche, it'll show you how many months it will take you to pay it off. So you get to customize the spreadsheet and you select the debt snowball strategy that you want to use. So you can decide, and you see the avalanche, but you can also do you can do the debt snowball where you're paying the lowest balance first. You can do the stair stepper strategy. Okay, you can do debt snowflaking. This spreadsheet shows you how to do it, and it just, and it gives you an idea of what it's going to look like for you to do it, and why it makes sense to do it. And it also tells you, most importantly, how many months it will take. Not how many months, but what month will this debt be paid off if I use this strategy? So you see this one, the person used the avalanche, and it just shows you, September they'll pay it off. And how much. So so there's a cute, and the spreadsheet is very simple to use, very helpful for actually visualizing how you manage that debt. Now, cash flow is the big thing. So your typical consumer, let's say you're one of those consumers with $17,000 worth of credit card debt, what should you do? And let's say you decide to use one of those debt acceleration strategies. What else can I do to make sure that I have money at the end of the year or at the end of the month? I know, a lot of people, I don't want to do this. I hate a budget, but a budget is simply a way of telling your money where to go instead of, in hindsight, figuring out where it went. Okay. And you need to be cognizant of that. And I find that people typically tell themselves these 7 things. I don't have time to budget. Oh, yes, you do. If you can sit down and watch TV for a half hour, you got time to budget because it's going to take you half of that time to create a budget. It's not going to take that long. And they're actually spreadsheets. And I'm going to show you 3 tools that you can do on your phone that will pretty much create the budget for you. Making a budget is difficult, and I hate math. The math that you have to use is simple as subtraction and addition. So we're not asking you to create a budget and use calculus, and then you got to use all kinds of spreadsheets with complicated formulas. It's just simple subtraction and addition. I can do the budget in your head. You're not really doing a budget in your head. What you're doing in your head is you kind of sort of know where your money went, but you don't. That's not a budget. A budget is looking into the future and deciding or allocating where your money or your income is going to go. People say I'm budgeting because I'm keeping track of everything I spent. That's just a checking account. We don't need to know what you spend it on. We want to know what happens next month. You're still looking in the rearview mirror. The budget allows you to plan for the future. That's why you budget. A budget is too restrictive. Not if you're doing it the right way, because we know things always happen. You end up going to the dentist or you have a car repair. A budget should include those kinds of items, unexpected items, because we know that's going to happen. And there are always unexpected expenses, and you put that into your budget. And then finally, and I love to hear people say this, I make plenty of money, I don't need to budget. I most recently had a client who was bringing home $15,000 a month, and they shared with me their savings account and their checking account. When I looked at the balances, they had $1,500 in their account. I said to him, I said, are you kidding me? Where's your money? You make, and even after you pay your bills, you make $15,000 a month. Where is that money going? I don't know. Well, ultimately, we had to find out. And when we did create a budget and we started to look at where the money was going, it provided some insight. And he was very thankful that, through a disciplined process, we were able to look at that and figure out, what is he spending his money on? Some of the stuff, when he began to look at it, he says, I don't need all of that. And it doesn't make sense. And it didn't. So budgets can help you beat debt and win with money. So one of the budgeting tips that I always suggest, and budgeting is just like running your personal expenses like a business. Okay. So you may hear people talk about budget to zero. All that means is you start here. I don't have any money. Then the first thing you do is you say, okay, my monthly income is $4,000. Okay. And then you account for every single one of those $4,000. Okay. So you know where every single dollar went. I spent almost 20 years in private banking working with clients who had investable assets between $5 million and $70 million. Believe me, when I tell you, they knew where every single dollar went. Okay. They didn't just do this. I kind of know what happened to the money. They knew where their money went. And there was no, for the most part, there was no frivolity. They were very disciplined about how they spent their money and where their money went. They wanted to see. And it wasn't just big dollar amounts, like, oh, they only paid attention to expenditures above 5,000 or 6,000. They looked at the $100 expenditures because they wanted to know what were they spending their money on. And you should start, when you do that budget, you should start with, and it's really a cash management plan. You start with the most important items first, the ones that you know you're gonna have to pay: your mortgage, your car note, your health insurance or your insurance, food. Those are things that you're gonna have to spend money on every single month. So say I'm gonna, so just um, accept that you're gonna spend a certain amount of money and be sure to include that in the budget. You can trim the budget if you need to. Most importantly, track your progress so you can see what's going on. Create that buffer in the budget because there's always going to be unexpected items, and use cash for certain budget categories. And you don't rely on your credit card, because then you are just creating sort of a vicious cycle that you got to kind of get from up under. And then try an online budgeting tool. And I guess the most important thing is to be forgiving of yourself, because it's a process. Okay. And nobody's going to get it right the first time. I can promise you that if you just do it one time, you will gain some insights about the way you are spending your money and what you're doing. That will be eye-opening. Just do it once. Just do it 1 month. And especially during this pandemic, when we may or may not have more time, we may or may not have more money, but we know that the financial forecasts are going to be very difficult for at least the next year. This would be the time when you really do begin to look at your money and start a disciplined process so that you have more money at the end of the year. You're saving more. And as Rhenda mentioned at the beginning of this webinar, when you have more money in your pocket, it opens up the opportunity to build wealth and do that across generations. Because now you have the ability to do the kind of investments that my clients who had investable assets between $5 and $70 million were involved in. It's a process, but you got to start somewhere. I like these 3 tools: Every Dollar and Pocket Guard, and Clarity Money. One, because they're very simple to use. They got nice pictures on it. They walk you through the steps. It's really simple and easy, and they don't ask for a whole lot, and they're free, which is probably the thing that I like the most about them. Doesn't cost you any money. You just sign up. They're free plans, do a lot for you. Clarity Money. I like this one particularly because it will look at your checking account and a credit card, and it'll look at recurring charges like subscriptions and bills or whatever. Sometimes you subscribe to something and you don't even know that you subscribe to it, and more money is coming out every month. And that's happened to me a couple of times. I signed up for an audio book, and the next thing you know, I was on AudioFile or Audible at Amazon, and I'm not listening to any audiobooks, but I sure am paying $9.99 a month. And I was able to catch that because I used Clarity Money. And those little expenditures every single month, I could have been spending it on something else. I could have been paying a bill. It wasn't a lot of money, but it could have gone someplace else where it was much more useful. So you get used to that.
In addition to that, Michele, if you're not tech savvy as I am, sometimes you can have other measures that you can take. One of the things that I would tell my children is, when you are trying to figure out where your money is going, take 30 days and write down everything that you have spent money on. I don't care if it was 25 cents in a bubblegum machine. You can see where your money is going, and do you actually need to use that money for that particular item? For an example, he realized, as Michele has said, there was a lot of subscriptions he had that he didn't even use. So there was some money that he could remove and use it and put it somewhere else, or into his emergency fund. You don't have to get your nails done every week or your hair done every week. You can get it done once a month. You don't have to go out right now in COVID. Nobody's really going out, but you all are ordering out. You may have to cook, and you can save that money. There are ways that you can actually save money. And you need that emergency fund, because you never know what is going to happen. Your car could break down, something can happen in the house, but you need to have that money. And most of the time we're like, well, I'm working from paycheck. I don't know where I can cut any money. Well, there's a lot of places you can cut, because what's going to happen is when you get your check, you're going to look at that check and you're going to use what you see on that check. Have some money go somewhere else that you can't get to. I don't care if it's $20 a month or $25 a pay period. You're looking at you can save $600 a year just doing something simple as that. It's ways that you can save money because you're going to have some money to make money. Our goal is to have your money to work for you, you not to work for money. That's the goal in order to build generational wealth. There are things you may want to do, like get investment properties. And then the tenant will pay for your investment property. And your property will gain equity. You can use that equity to buy something else. And there's ways, there's principles that you can use to save money. Then you may have to use one of my favorite words, and that's no. A lot of times people want to borrow money from you. You just say no. And if they ask you why, just tell them what part of no you don't understand, the N or the O. I'm sure they will get it. Because if you continue to lend money out, you only lend money and give it away because there's no guarantee that you're going to get that money back. So the goal is you got to figure out what you're going to do with your money. You know how they say money is the root of all evil? Well, the lack of money is the root of all evil. And I know that people are saying we're in COVID. Some people may have lost jobs. And this is probably a good example. People have lost their jobs and they have no money put away for when something happens. So they can't pay their bills. And back in the day, what did your parents tell you? Always have money for a rainy day. Have 6 months worth of bill money put away. Back in the day, we didn't have a problem getting a job. Now it's taking people years to get a job. Be creative and find ways to make money. There's yard sale, which is one of my favorites. All that stuff you're not using, they have stuff online that you can sell online. You can find ways to make money. You can take that money and say, what can I do to make this money make money for me? So we have to use some of these principles and these strategies and stop using credit cards. If you're going to use one, make sure that you can pay it off the next month and get one of those that give you money for using it. Now, if you're just starting out, you're going to have to get a credit card because you have to develop some type of credit history. No credit is worse than bad credit. And most people think cash and carry is the way to go, but not in this society.
That's right.
We have to show some type of credit history to get what we want. And then after that, you can go cash and carry because you already got a history established, or you can use a credit card, but don't spend more than you can afford to pay off the next month. Try to get the best interest rate you can. You can't get that with a bad credit score. If you want to buy a house and you wonder why it's 2.99 and I make this, but my girlfriend makes more and her interest rate is 4. Her credit may not be right. And they look at other things besides just your credit, the weakness of, your job, how much you make, what your credit history is like. So there's a lot of principles that you can put in place. I hope you really enjoyed this seminar. Again, I apologize for the mishap earlier. And just remember that today's discussion is for information purposes only. No legal, tax, or financial advice given during this presentation should be interpreted as a guarantee for your personal situation. You should consult with legal, tax, or financial advisor for your specific situation. There is a question, Michelle, that we have on the in the chat box. Are you ready to answer that?
Yes, absolutely. Go right ahead. I see it. If somebody gets sent to collections, you've been heard not to pay. No, that doesn't, it's in collections. And I think I mentioned this, you've already taken a hit on your credit bureau. If you look at it, it already has gone to collections. Do you just ignore it? No. If you can pay it off, or if you call collections agency and negotiate with them to see if you may be able to pay that, pennies on the dollar, you should try to do that because it will show up that you have negotiated and you paid it off. So as a strategy, if it goes to collections, don't ignore it. That's not necessarily going to be the best thing that you could do. You should try to do that. Now, I see another question in there. You want a copy of that debt worksheet? Not a problem. I think there's a question there. There's the, and actually, if you're listening, let me give you my email address. If you email me, I will send you not only the, and what we are going to do is we're going to send everybody the presentation deck. And we are also going to include 2 things. We're going to send the Excel spreadsheet that I showed you on the previous slide. And we are also going to give you the name of that website. And if you give me a second, but if you go into Google and you type Free Credit Bureau, I think it comes up something like that. And it's legitimate. Okay, you just go in there and all three will come in there and you can take a look at it. You'll see all the credit people that are looking at you, all the loans or the credit cards that you have. And you'll also be able to see whether or not there's any derogatory information that has been reported to you. Like I said, in preparation for this webinar, I went in there and did that. And like I said, that Michele Hallman in Alabama, she's cutting up during COVID, and I had to straighten some things out and protest it because Michele Hallman in Maryland is doing all of the right things. I don't want to be responsible for the bad things that Michele Hallman in Alabama is doing because we're not the same person, and I need the credit bureau reporting agencies to make sure that they understand that. Do we have any other questions?
Question, yeah. But before we get to that, Michele, there's one thing that I want to reiterate because we do have some young people, when I say young adults, on the line. It's very important that you check your credit report because what we have found that some parents, and shame on you parents, are putting or getting credit cards or putting bills in their children's names, and the child has no idea. And then when they're trying to buy a car or get a condo, they realize they have this debt that they have no idea where it came from. And it actually was open up an account in their name. So by checking your credit report yearly, and you can get a free one every year. You can go on free credit report online. You get one every year. And if you are rejected from credit, then you can pull another one because they have to give you a reason why that you were on your credit report. Identity theft is really high now. It's very, very high. So you have to keep an eye on it just to make sure that someone else is not walking around using your good credit for their benefit. There's another question in the chat. I'm trying to see. Do you know when you pay on time, have good credit? I'm trying to read it. What do you do when you pay on time, have good credit, and the creditor lowers your limits, which lowers your score? It's probably your debt to income ratio. Right. Because if you can have good credit, but if you have a lot of debt, they're gonna look at you as a risk. So you got to get that debt down. So once you get that debt down, then you'll see your credit score going up and you will be lend more because you got to look at how much you make. So you're only worth what your assets are.
And then here's the other thing. If you have a credit card and let's say the limit is $5,000 or $2,500, you've had it for a significant period of time, but the most amount of credit that you've used is $1,000 or maybe $500. The creditor says, why am I at risk for you running the card up to $5,000 or $7,000 when I see over all this time you've only used 100 of it? I'm gonna bring that down because I don't feel like I need that kind of exposure. The most you're gonna probably use is 1,500, so we're gonna drop you down to the 1,500. But also sometimes, as Rhenda mentioned, it's because they do a soft credit pull and they see that you have applied for credit in other places. And they say, you know what, given their history and how much, because when you apply for store credit, they ask you, what is your income? So they know what your income is. Given the income that she told us that she made and this recent credit that she's gotten, I don't think we want to be exposed and have to, for her to run the card up too much. So we're just going to bring it down to an amount that we're more comfortable with. So that, you'll see that happen. And I have to say that even happened to me because I had a very high credit balance on a credit card limit at Macy's because I bought some furniture. So they, of course it was that. After that, I wasn't, I was making little intermittent purchases here and there. And they decided that they would bring and it wasn't that much, but it was almost like a slap in the face. So I understand your question. And you can also give them a call and ask them, why did they lower it?
On the flip side of that, Michelle, if you notice when you don't use a lot of debt because they want you to use the credit, you'll see we have increased your credit line. So when you have a low debt rate, then they will increase it as well. But when you have a high one, they will decrease it because at that point it's called risk pricing. There's another one thing came on, said, for people who have judgment against them, they may have their wages garnished if they don't address the debt.
Yeah, that's true.
And just remember that sometimes when stuff is paid off, like for instance, a short sale, you do a short sale, and then they say you may get a 1099 because they look at that as a gift. And sometimes they suspend it, but that doesn't mean that it was not on your credit.
Right. So let me go back to that lien situation, which happens with some frequency as far as your tax debts. And let me say at the outset, it takes a very long time before you get to the point where the IRS has garnished or starts garnishing your check. And by a long time, I mean you have gotten at least 15 letters from them, and each letter, as you would expect, is more and more threatening to let you know that some kind of imminent action is going to be taken against you. You ignore those letters at your peril. So you'll get a notice of a deficiency, then you'll get a notice of a potential tax lien filing. Then the IRS will file the lien. You ignore the lien, and then at some point the IRS says, oh, we're tired of this, okay? And then they will seek you out where you work, which is very easy. All they got to do is look at your W-2 information and find out where you work. They get a judgment. They already have a judgment against you, and then they submit that judgment to your employer, and your check is then garnished. I have unfortunately had that happen to a number of clients, and it's always very frightening because the statute in Maryland and in DC pretty much lets the IRS take almost 75% of your check. So do you want to get to the point where they're doing a wage garnishment? No. What you want to do is you want to pick up the phone and you want to talk to them and get in some kind of payment plan, because as long as you're negotiating with them, they won't take any action against you until you put some kind of plan in place. But when you ignore them and you owe them a bunch of money, they will come after you. I think we have another question.
Yeah, you have two. It says, what happens when you increase your credit limit? What happens when they increase your credit? Does it still, and you don't use it, does it hurt your credit? No, actually, that's a good sign. That means they trust you to give you more credit, but that don't mean you have to use it. The next question is, I'm trying to raise my credit score, which is currently 704 to 720. My bankruptcy was charged off 2 years ago. I have one credit card that I paid off, but I owe 32 in student loans, which I can pay off, but I don't want to take a nice chunk out of my savings. What would you suggest?
Do not use your savings to pay off that student loan. Do not do it. I would imagine that maybe your student loan debt is probably, the percentage is maybe 6 to 8%, if even that high. That's pretty low, because if you carry that same amount of debt on a credit card, you would be paying anywhere between 18 and 25%. So no, don't pay that off. Keep making your payments regularly, and take care of that. You want more credit, you're gonna have to apply for some credit cards, or or get a car loan. But let me be clear and sort of temper your expectations. You want to raise that credit score, and that's admirable. But that, even if you raise the credit, even if you do apply for new credit, which is ultimately going to help your credit score, you need to show that you've consistently made payments on that new credit card, right? And that you're not a big credit risk. So it's going to take time. If you're looking to really jump your score up, you need to take a look at your credit bureau and see if there's any kind of mistakes.
There's another question, Michelle. I'm trying to get to it now. Wait a minute. It says, what do you do when you pay on time, have good credit, and the creditor lowers your limits, which lowers your score?
Yeah, I think we talked about that.
You talked that one?
Yeah.
Okay.
You can call them and ask them why they lowered your score. You're
Okay.
right. And you know, we all
It
think,
says, all right, I'm sorry.
yeah, go ahead.
Before I ask the next question, let me say this to a lot of parents. If you don't have the money to pay for your child to go to college, have them to go to a community college, because taking out loans, student loans, or pulling money out your retirement, you can't get that money back once you put in for your student loan, for your child's student loan. My suggestion is, if you don't have the money, do not sign for the student loan. Let the child sign for the student loan. That don't mean that you can't help that child once the child signs for the student loan, but that's one debt you don't have to worry about that is going to be allotted to you. And that's the mistake. Most people will say, well, you know, I promised that I would send my child to college. That's fine. But if you can't afford a private college or an expensive college, there's nothing wrong with a community college, because once you finish and get your degree and pass those boards, most of the time they're not going to ask you what college did you come from. They want to know if you passed those boards or got those certifications. And you're going to make the same money if you went to school to become an RN that went to Harvard and paid $60,000 a year, and you went to PG community college and you paid $5,000 a year. You still are RN and you still be able to get a job. The next question is it more beneficial to deal with the IRS versus the companies that you say can deal with the IRS for you and reduce your payment to the IRS?
Oh, I'm so glad you asked that question, because I have very strong feelings about that. Deal with the IRS. Don't go to those companies. And I'm thinking about Optimum in particular. And then I think there was another one, a woman, Rory Benton, I forget what her name was. Don't. Because the process for them is they will charge you no matter what the credit card debt. They initially say, well, for us to just review your account, it's $750, and then it's another $750, and maybe even more than that. And the only thing they're doing is picking up the phone and putting you in an installment agreement, which you could do yourself. Okay. Meanwhile, you have just spent $1,500 for them to get in the installment agreement that you could have got in yourself. So don't. And then there, you know, you're basically dealing with someone who's probably in Texas or Utah or whatever. They hardly care about you. You're just another person on the phone. And I got to tell you, I end up seeing a lot of clients who have gone through those tax services, and they never have a happy experience. Well, initially they worked with me and then it sort of fell through, or they didn't do what they said they were going to do. Don't do that. You know, honestly, you could pick up the phone and call me. At least you know that I'm a real person and I'm gonna do what I say I'm gonna do. You know, it just works out a lot better. And if you're uncomfortable doing that, then at least try to do it yourself. Make the attempt. As I said initially, and I feel like I say this all the time, the IRS is nothing but one great big collection agency. That's all they are. They're just a collection agency.
And whatever agreement you make with the IRS, try to stick with that agreement. And if you make that agreement feel like this not working, just renegotiate. They will renegotiate with you, as long as they know that you're trying and you are making those payments. The thing about it is most people will make those arrangements. It's like, really can't afford that arrangement, and then they end up missing it. Then the IRS is back after them again, and you're looking at more penalty and interest. Whereas you can talk with them and say, this is what I can afford. And if you make that payment as scheduled, you won't have issues with them, and they will honor that.
Yeah, and Rhenda, you make an excellent point. I negotiate settlements and also agreements with the IRS, and I have to talk to these revenue officers because, you know, maybe the client owes a whole bunch of money, and the IRS, well, I want them to make a payment of $3,000 a month. And I have to push back on them. And I said, I'm not going to agree to that for my client, because they will miss the first payment. You have the same numbers in front of you that I do. Let's talk about a much more reasonable payment so that they don't default right out of, right out of the way, out of the gate during the first month or first 6 months. And you have to push back on them because they're, most of the revenue agents, they have a formula that they're looking for. They're trying to close out the debt within a very limited time period, and they are reluctant to extend it beyond that because it means for them having to go to a supervisor to get an exception. Not my problem. Okay. I'm not going to put my client in a situation where they're not going to make the payment. And as you mentioned, Rhenda, they're going to default on it. That's just crazy.
And I think you mentioned earlier, Michele, about the avalanche. And a lot of people are like, that's a big amount. We want you to set attainable and realistic goals. So if it means to paying off those smaller amounts first, then do that. At least you can see some source of achievement, and you can take that amount and put it on that higher one. For some of the young people, you want to get out on your own because you think you've grown, but the saying in my household or my parents' household, you're not grown until you own, and therefore everything in their house is on loan. So when you're trying to save money, you may get out and get an apartment that's $2,000 a month. Mm-hmm. You may want to say, I can't because, I'm paying $2,000 a month for rent, and I'm paying a car note. You may have to, suck it up, move back home with mama. And I'm sure if you paid her $1,000 a month, you got $1,000 left that you can save. Or if you can't come back home, get a roommate. But find some way to start developing that emergency fund. There are ways that you can do that. I'm going to keep trying to reiterate that because you don't need that $1,500 purse. I'm going to give you a good example. I had a friend of mine, the purse that cost me $29.99. And I was proud because it was a cute little purse. And she said, I cannot believe that you're walking around with a $29.99 purse. She showed me this bag. She said, I paid $1,500 for this purse. And I said, you know the difference between my bag and your bag? And she said, what? I said, I got $1,470 to put in my purse. What you got to put in yours? And she got mad at me because it's something material and I'm taking that money to do something else. So there are ways for you to make money. There's ways for you to save money. Right. And once you get that money and we go to these principles, we're going to show you how to make that money work for you and start building that wealth.
Right. Because, and Rhenda, let me just piggyback real quick, because the whole idea is, the whole idea of this webinar is baby steps. Some of these concepts you're already familiar with, you already know, but you got to master these or at least be on a nodding basis with some of these cash management moves. Try to do a budget so or I should say cash management plan so you know where the money is going. You got to get your arms around the credit card debt so that you have money at the end. Broderick, who is also part of our team of experts, who's not here this morning, and we had a conversation, and he pointed out something to me, which I know from our crisis back in 2008 and 2009 is going to happen. People are staying home. They're not traveling. They got more, if they haven't lost their job and they're not struggling, and they have more money in their pockets. And the people who invest in the stock market or who, or maybe in the real estate market are just sitting there and their money is just piling up and piling up. As things begin to open, all that downtime where people were not spending their money is going to come back like a roar. Okay. You want to be a part of that because there'll be opportunities. But if you still lackadaisically addressing your credit card debt and you're not doing anything about it and you're still finding ways, even in the middle of COVID, to spend money, you'll never be able to take advantage of the wonderful business opportunities and investment opportunities that are going to happen within the next 18 months, guaranteed.
Michele, I think this is a new one. I'm not sure, but it looks like once a bill goes to collection agency, are you able to still pay the debt directly to the original creditor? Collection agency will say the debt was sold to them and you must pay them. If so, will the credit bureau acknowledge that the debt was paid to the original creditor in full and dismiss the credit collection request for the payment?
No, they will not. Because it shows up on your credit bureau that it went to the collection agency. They are now the holder of your debt. And the entry on your credit bureau will say collection agent. It might actually give the information collection agency as a sometimes, and it'll tell you who it is that, that they got the debt from. But now you cannot go back to the original creditor, because it's not on their books. They charged it off on their taxes. They basically said, we're never going to get it. We're taking it as a loss. We've already given it to a collection agency. You don't exist. You're dead to them, in other words. So you have to negotiate with the collection agency and try to get that debt paid off. And you can, with them, you can really talk to them about pennies on the dollar. They are going to resist. They are, I don't want to, whatever. But to be honest with you, they bought that debt from the original person for pennies on the dollar. That they should get the full amount from you, for all practical intents and purposes, doesn't make sense. If, let's say, they paid 80 cents on the dollar and they're trying to get the whole dollar from you, they're making money hand over, they're going to make money hand over fist. I would want to just pay them. I'll pay you the 80 cents that you paid Macy's or whoever, or, whoever the debt is was originally held by. But it's, the short answer is no, you have to deal with the collection agency, because you're dead to that original lender. They've written you off and you're gone and lost forever. They won't have any record of you, more than likely.
Michele, I'm not sure we answered this question, but it was a question part two was asking if they want to get out of a timeshare and want to know the possible implication on my credit.
Oh yeah, those timeshares. I got to tell you, there's a lot of scammy companies that you have to deal with, but there are also secondary markets for timeshares where sometimes you can sell your interest on your interest in the timeshare to somebody else who may be interested in buying it from you. It depends on the timeshare and who you have it from. Marriott and a couple of other big hotel chains really have a strong timeshare market. They're usually really kind of easy to deal with and you're able to sell it. But if you got a timeshare with some kind of janky company and you're trying to get from up under it, it's going to be problematic. And you should probably try to sell it or get from up under it, but don't ignore it, because they probably will ding your credit bureau report. The only time, I got to tell you, the only time I had and it was still difficult. I had a client, a husband and wife, who unfortunately passed within 6 months of themselves. They were very wealthy and they had 2 back-to-back weeks of the timeshare in Italy, overlooking, I don't know, the Mediterranean. It was wonderful. When they passed, we had to try to sell it. You would have thought people would have been lapping it up because, it was in Italy or whatever. But we ended up trying to sell the timeshare, and we got not even, we knew what it was worth. We got less than half for it. And the timeshare was not that expensive. I mean, it was like, we had to sell it for like $4,000. Nobody wanted it. It's, people don't want to buy it because you really aren't buying property. You're buying the ability to vacation in a particular location once a year or twice a year. It's too nebulous. It's not a property interest. It's almost like you're buying, it's an option to do something. So they're hard to get rid of. Make the payments, try to sell it if you want to get from up under it, or at least try to trade up to something that you really are going to use much more frequently.
Okay. But this concludes our, if there's no more questions, this concludes our session for today. But before we go, I want to let you know that we do have a financial advisor by the name of Broderick Young. And he was unable to be with us today because he lost his grandfather, and he's in Mississippi today, attending his funeral. So please keep him in prayer, and that he will be back on the other sessions that are scheduled for the next 3 months. The next one is going to be January the 9th at 12 o'clock. And we're going to be talking about estate planning, probate, wills, trust, and tax advantages. And Broderick will also go over some stocks and bond or mutual fund and investment tips as well. during that session. So I hope to see you all next month on January 9th at 12 o'clock. We really thank you guys for your time.
And Rhenda, let me just jump in here about the next session. I know that there are baby steps, but I want to tell you, I'm really excited about the next session. Cheryl Henderson, who's a wonderful trust and estates attorney, is going to be presenting what you think you know about probate, what you think you know about trust. You don't know. You don't know. Cheryl is going to illuminate that and tell you all about it. I will be showing you with clearly and easy to read charts why you should have a trust if you, for instance, own property in multiple states or you have a complicated estate, why it is absolutely necessary, from just the saving money and not putting a lot of complications on your family who should be mourning you and shouldn't be trying to hire an attorney to take care of everything, why it makes sense to have a trust. And then Broderick's going to talk to you about, one of the big first steps in building that generational wealth, which is how do you manipulate a trust so that when you die, you're passing on money to the next generation, to your children, to your grandchildren, and to your great-grandchildren. They will always remember you fondly, but honestly, the money adds a little extra to that proposition and almost makes it a guarantee. So when Cheryl and Broderick and I begin to talk about those things, you'll see how the generational wealth building blocks begin to take shape, and you'll see how that all forms together. And now when you have a little extra money, how you can take care of the next 2, 3, 4, 5 generations. Once again, I want to point out, when I was working in private banking, every one of those high net worth clients had a trust or they had an estate plan in place. They paid attention to their money and they paid attention to the next generation. They made sure they took care of it. So we need to do that as well and make the plans while we are capable of doing that.
In addition to, and we can also talk about how the trust can actually protect your property and protect you, because in the event that you get in a situation and you are sued, it may not be able to touch your property because it doesn't belong to you because it's in the trust. So also would be ways that they can show how you can protect your investments as well. So without any more, I think someone sent something. They want to know, can they share this information with others? Absolutely. Those who have attended will get a copy of this seminar or this session as of today. But if you like, at the end of the series, you can get the whole 4-part series, which will be finished in March. Again, we appreciate all of your time and out of your busy schedule to make this a successful session. Thank you again. And thank you all for all the accolades that you have given in reference to this session as of today. Good luck and see you next month.